please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
It looks like flat on the Nifty. Yes, it's flat on the Nifty. It's 10 points down, 11 points down. That's it, 11.5 down. But we'll have to look at the big fellow. Yes Bank, the traded rate is also 5.3 down. And then you have, of course, BPCL, Vedanta, Hindalco, Reliance. See, the metals are not celebrating the rupee fall because globally metals have also fallen. BPCL was always expected to be a victim of both higher crude and lower rupee. Power Grid as well is seeing profit taking. Axis Bank has seen a bit of a fall. All the banks will fall because the Bank Nifty is down 0.4 almost. And that's obviously because their bond book is going to look that much weaker. An MTM loss is a given with the yields going to 7.95 or thereabouts. So no unusual falls. Yes Bank at 5.7 down seems to have found a little bit of support. Now it is, okay, 4.9, not a great deal. I think you will see the support eventually, probably. The gainers are very obvious of the rupee depreciation. The pharma guys, Sun Pharma, DRL, Cipla are 3 of the top 5 gainers. Other gainers, again, ONGC, obvious gainer because of the higher crude prices. Then the IT stocks, Tech Mahindra, HCL Tech, Infosys. So the top 10 gainers are either it's a oil stock like ONGC, or it is a pharma stock, or it is an IT stock. Very predictable way in which the market has behaved so far. The Bank Nifty losses are not very steep. It's actually recovering now a goodish bit. Let me see if it's because of Yes Bank. Yes Bank has recovered 1 percentage point from the morning's lows. Mid-caps?
Well, you know, in the mid-cap space, Lata, it's flat for now, the opening. The market breadth is good, though. 700 stocks on the advancing side. The entire aviation space is under pressure. Jet Airways particularly is down about 2%. The Registrar of Companies, as we said, is probing allegations of fund siphoning at Jet Airways, so that is not looking good. Interglobe is also down with the way crude has been moving up. It doesn't help these companies at all. Idea Cellular, though, is on the upside. The Idea-Vodafone merger has got the NCLT approval, so that's a positive. 5% higher now on that stock. You have HCC that is slightly under pressure. Just pull up HCC for you. Its project Lavasa is in NCLT, so let's see how that shapes up. But it's still a 13 rupee stock, so some pressure seen there. Some of these companies, you know, in the pharmaceutical space are looking good on the upside in the broader markets, that is. So keep an eye out on that. From the frontliners, it's Dr. Reddy's that's topping the charts in pharmaceuticals. And also some of these names, you know, like you have PTC India, ICICI Securities, Granules India, etc. are up about 2-3% But otherwise, it's a flat opening for the market, slightly subdued. The Bank Nifty, by the way, is under quite a bit of pressure. Of course, Yes Bank is also dragging its feet, but otherwise, even some of the larger ones, Axis Bank, etc., putting pressure on the Bank Nifty now.
Yes, Sonia, so that's the market opening. I think the stock of the moment, the opening tick, which looks really interesting, is Bajaj Finance, because that one had a big fall yesterday, and today it's, you know, if you see the first tick, it's trying to bounce back quite a bit. And if you see the, actually if the opening intraday could come up, that one from yesterday's low is seeing quite a bit of bounce. So that would be one stock that I'll be tracking. And of course, you know, there's a bit of a pressure on the Nifty Bank as well. Ashwini, your thoughts on market opening?
The Bank Nifty futures are at a premium of 170 points. Nifty futures premium is 55 points. And there is bad news, quote unquote. But somebody is buying Bank Nifty and Nifty like there is no tomorrow. So this sort of gap down that you have on the cash indices should be bought fairly strongly. I think as the market stabilizes, both Nifty, Bank Nifty should head higher, because if the market was negative, you should have had a downside opening, probably things, you know, close to a discount or something. But definitely, you know, Bank Nifty is open 100 points lower, and the Nifty futures is open 150 points higher. So something is going on here. For the moment, what you can do is keep yesterday's low as a stop and start to buy. My sense is whatever happens with the rupee should lead the market higher.
By the way, I tell you something. Someone's buying big on HCC after that opening tick of 6% lower. The thought process here could be, you know, as Nigel was also pointing out earlier, now that It's gone to NCLT. It's no longer going to be a liability on the company to pay the interest burden. So the stock opened 10% lower, but straight away has actually almost moved into the green. So that really is the interesting stock, which looks quite interesting.
I don't know.
Right now.
I find that very strange. If you cannot pay, then equity has no value.
But for the Lavasa, so it on the books for HCC, it will not show anymore as a burden. It's, once you remove Lavasa, obviously Lavasa we know has no value, but at the end of the day, that's acting as a big elephant on their books. That was not going to be the case. I really
want a legal opinion on whether HCC goes scot-free, but I don't know enough about it. Yeah, but Sudarshan, now with the market settling down, with a minor cut, which is getting minorer and minorer. Now it's actually got into flat terrain. Only the Nifty Bank is showing a bit of 0.25% cut, and the mid-caps have shot up actually, 0.4% higher. What's the trade now? Trades now, Sudarshan.
The trade is to go and buy the Nifty. Don't wait. We have had a dip towards 650, and obviously the markets won't wait for us. Go long in the Nifty. Even in this consolidation, we will see gains. And quickly to Anuj, nobody rewards equity if you wave off the debt. Be sure about that. Equity shareholders will never be rewarded.
Oh, of course, that point is well taken, Sudarshan, and that is not being debated at all here. Anyway, let's move on. Ashwini, what's the big call for the day?
Well, there's something funny going on, because why these huge premiums are there. My sense is you should buy, and whatever the bad news is, the market seems to be in a mood to buy. And I wouldn't be surprised if you get to the higher end of the range. There is totally no amount of negativity that you can see on the price action. Even on Yes Bank, you should buy. Probably by end of the day, this 4% lower will become 1% or maybe get into the positive also.
All right, gentlemen, thanks a lot for joining us and taking us through the market opening. We'll keep coming back to you. Our market master for the day, Reddy Subramaniam, now joins us, Group President and Head of Equity at UTI AMC. Reddy, good morning. Good to have you on the show. Fund managers feeling a bit more relieved now than they were, say, 2 months back. The market's rally this time has been slightly more broad-based.
Yeah, I'd say, compared to a month ago, it's certainly become a lot more broad-based, but it's been a bit of a narrow market for, I'd say, pretty much year to date. So those challenges, in a sense, sort of continue. But, it's been a nice, good rally over the last year and a half, very strong rally over the previous 5 years. So, fund management is always a challenge. I cannot quite recollect when it has not been a challenge.
Okay. Good morning, Vetri. But is it a little, do you feel nervous buying over here? Valuations, people tell us, are at a 20% premium to the average, long-term average.
Yeah, Lata, I think as far as, valuations are concerned, that's been a challenge. It's been a challenge in the past as well. It's, I think in the last 2-3 years, it's always tended to trade at a significant premium to the long-term average. And there have been only a few cuts, few and far between, where you've managed to sort of get in at slightly healthier levels. So it's been a bit of a challenging market, but, that's also, I think, reflected in the fact. And if I were to just pick a point, and you could accuse me of being, using only selective data points, but if I go back to, let's say, March of 2015, where the market sort of went up to almost 25 odd times on a trailing earnings, we're now, of course, even higher than that. And if you look at what's happened to the Nifty from March 15 to today, then the CAGR is something like about 7 or 8%, which is, nothing great. But at the same time, it just, sets you up or gives you a perspective on the fact that when the market is pricey, you have to sort of be a little bit more careful about your return expectations from the asset class. Obviously, to the extent that we run equity funds, the funds we run are pretty much fully invested. There are only 1 or 2 strategies where we, have our own internal asset allocation models, which guide us in terms of what equity allocation we would like to have. And as far as those products are concerned, we've been continuously reducing asset allocation. So, in our multi-asset hybrid fund, we've been continuously reducing our equity allocation, largely driven by valuation concerns.
Okay, so you're reducing equity allocations because of valuation concerns. Vetri, hi, good morning. Thanks as always for joining us. You know, there are many macro headwinds that we're dealing with right now, whether it's higher crude prices, a rising fiscal deficit, a weaker rupee. Do you see these issues drag the markets down in the near term, or do you think that the market will continue to climb these walls of worry?
Well, I mean, given the background of what's happened over the last 1 year, I'm not sure I'm well qualified to answer that. If we'd had this conversation a year ago and we'd thought up a scenario in which the currency would fall by 10%, bonds would see yields go up by 150 basis points, the current account deficit would start to get close to a 3% run rate, and oil prices would be up, whatever, 40-odd%, though I'm not a great fan of what oil prices do. Our base case then would not have been that over the last 1 year the market would be up 18%. So I would actually submit to you that we've already been climbing a wall of worry quite well over the last 1 year. It could well persist, I don't know. But that just tells you that, sometimes these correlations are important, but at times, the causation is not always very clear to us.
Okay.
So could it continue to behave the way it is in spite of these factors? Who knows?
Okay.
I can't remember who could have put this irony so beautifully, Vetri, the way you wrapped it up.
Okay. Vetri, so from your point of view, what could be the trigger for this market to head lower? Because so much bad news been thrown at the market. I mean, this morning, for example, we're talking about rupee where it is and crude where it is. There's been, of course, state elections around the corner. There's been some global uncertainty, but the market just keeps inching higher. So what do you think could be a trigger for a possible correction for market?
Hard to say, Anuj, and these things are never clear ahead of time. I don't think anybody could go back and clearly point to the risk factor which was completely visible either in 2007, 2008, or for that matter, even if you take the small correction that we got in 2015-16, where the market dropped almost about 22-24%. I don't think you could really go back to 2015 and be able to pinpoint precise what it was that caused the market to then drop 20% over the next 9-10 months. So these things are virtually impossible to predict, and I think the nature of the beast is such that very often the things that we discuss the most sort of tend to get discounted into the price, whereas it's the unexpected that is in nobody's thought process. It's the things that we don't know which actually end up doing the damage. So we don't know where that is at this point of time, but if you do believe that valuations give you a good reasonable roadmap of how to deal with risk, then effectively what the valuations are telling you is that you're not really being adequately compensated in terms of valuations for taking the risk in equities at this point of time, or at least being hyper aggressive about equities at this point of time.
Okay. So have you made up your mind? Are markets a puzzle or a mystery? I saw that in your tweet.
No, I think it is always a mystery, and the simple reason for that is you actually don't know what are all the factors which cause the outcome, and there can be multiple outcomes, whereas with a puzzle, it all eventually falls in place, but with the market it's always an unknown.
Okay. Well, that was just on the lighter note, but Vetri, let me come to sectors. The much prized, much valued private sector retail banks are now not the best performers. We have seen money shift to the private sector, generally to the corporate lenders. Do you see more of that trend happening? That you may see, not exactly false, but underperformance in the retail banks and outperformance in the corporate lenders. Is this trend to continue?
Well, Lata, you should always be a bit careful about, reading too much into what's happened over 3 months or 6 months. There's been huge outperformance by these retail banks over the last 3 years or 5 years. But I am sympathetic to the idea, and you'll see this in at least some of the portfolios that I run, where increasingly we are getting a lot more comfort with some of the corporate-oriented banks. We do think that, the worst of the asset side deterioration is now behind them. It's been well recognized. It's been well telegraphed to the market. As far as P&L recognition recognition is concerned, there could still be a few speed bumps along the road, but that's only the recognition in the P&L. The balance sheet damage is already now well known, well captured. So we would tend to believe that, you know, going forward, you should start to see much better sort of performance from some of the corporate oriented banks, simply because in their P&L, there is a very strong case to be made that the credit cost can actually drop quite significantly over the next few years. Having said that, I would still reiterate that whichever bank or financial institution you are looking at, the two things that become very important is the quality of their liability franchise and the strength of their capital adequacy, because that is what will allow them to grow over the next few years. And if there is any weakness on these two parameters, then it becomes not so attractive. So it's not as simple as saying all corporate banks are buys, but if you've got corporate banks where, you know, the capital adequacy is healthy, they can continue to go for growth, and the liability franchise is good, then certainly it might be something to look at.
Okay, so you're feeling comfortable about some of these corporate lenders. Are you also feeling comfortable to increase exposure in the pharmaceutical space, Vetri? A lot of companies talk about the worst of the pricing pressure being behind them, but that's something they've been saying for many quarters now. Stocks have run up though. What's your own view here?
A good question, Sonia. I would just say, you know, there's a disproportionate amount of focus when it comes to pharma to people just looking at what's happening in the US generics market. Keep in mind that the US generics market, based on the company we are discussing, could be anywhere between, you know, 10% of profits to maybe 35-40% of profits. So there's a big chunk of profitability that comes from India, that comes from emerging markets. And I think the Indian market opportunity continues to be quite robust. It's growing well. The sad part is that, you know, as societies evolve, as income levels go up, and unfortunately pollution levels and stress levels go up, people tend to fall sick a lot more with chronic conditions, and it may not be good for all of us as a collective, but it's good for these pharmaceutical companies that produce the drugs that, you know, meet those patients' needs. So I think there's a good, strong domestic franchise for some of them. I think a lot of the pain in the US is now already in the numbers, and when we look at valuations, this is one of the few sectors which increasingly starts to stand out in terms of the fact that it's been derated quite significantly, and we do get some comfort from the valuations. They certainly need to pick up their return on capital metrics. Some of them have seen significant destruction, but keep in mind that they're also spending very aggressively on their, you know, portfolio of complex and specialty products, almost 6 to 7% of revenue, and maybe the payback on that is not yet in the numbers. So there is scope for return on capital to improve as well. So we are incrementally quite positive on that area, but you need to pick and choose the companies. The winners in the next upturn in pharma may not be the same as those we've known to do well in the past.
Actually, I wanted to extend the same question, but on a slightly larger note, Vetri. The new normal for FY 2018 looks like a rupee that has slid and could slide more, and yields that will be closer to 8% compared to an average of probably 7 to 7.5% last year. So how does that change your portfolio rejig?
So Lata, you know, I've learned the hard way over a very long time that you can't really keep trying to rejig your portfolio too much to try and sort of reflect what might be the current macroeconomic trends, and you sort of back companies to deal with the macroeconomic challenges rather than try and continuously reposition your portfolio. So I'm not a great one to sort of continuously rejig portfolio, but the operating mantra for me, not just today, but for the last, I would say, you know, 3-4 years has been that we want to be invested in companies that have got, you know, reasonably strong cash flows, balance sheets, and perhaps are in a situation where they can grow through the next growth upcycle that the country witnesses, rather than you know, be invested in companies that are still trying to address their internal issues, have poor cash flows and weak balance sheets. So, you know, I think the strong will just get stronger through the next cycle, and if you're able to get them at reasonable valuations, then that's what makes them attractive. So I would say that is the underlying thought process, and trying to change portfolios too much based on short-term tactical considerations, even more so macro considerations, is actually fraught with a great degree of risk.
Right, Vetri, we leave it there. Thanks a lot for joining us. The market's breaking out, by the way. Just look at that. The Nifty is up 45 points from the low point. It's a stunning recovery that you're seeing. The mid-cap index up 110 points. And a lot of stocks which are really recovering. Of course, Yes Bank has recovered quite a bit, but Infosys is taking the markets to high point of the day. IndusInd Bank, Sun Pharma, Axis Bank, ICICI. So a lot of these stocks doing well right now. and the market at the highest point. In the broader market, the stock that really stands out now is Piramal Enterprises. There's something going on in this stock for last few days now. 5.5% higher on Piramal Enterprises. Just look at that move take place right now.
There is a buzz that a big guy is joining them.
Yeah.
I can't say more than that.
Yes.
It's only a buzz.
I think the market has the knowledge.
Yeah. So maybe market's also just guessing, and unless proved otherwise, people will continue to speculate.
Yes.
Okay.
P.S. I mean.
Let's leave it at that. Since we have not confirmed it, let's not get into this. But Piramal Enterprises has been a stock on everyone's radar. We've been talking about banks and NBFCs, and here's an occasion to talk about both, actually. The IDFC Bank shareholders meeting is scheduled to take place on the 3rd of September, and the Capital First shareholders meeting will be towards the end of September. Both these groups of shareholders are going to decide on the merger, are going to vote on the merger, and by now we know all the details of the merger. Ahead of that, we invite V. Vaidyanathan, Executive Chairman of Capital First, to clarify some doubts or some issues on which shareholders will argue with themselves before they do the vote. Mr. Vaidyanathan, thank you very much for joining us. Well, the first question that might occur to a shareholder is that Capital First was retail, 90%. And that gave you a great price. You were at 900 before the merger. After the merger, you're at what, 650 now? So, why are you getting into institutional or wholesale? What would you have to tell them?
I think this was one of the key concerns, shareholders had after we announced the merger. And I think it would be a valid concern because close to about 50,000 crores of infrastructure and wholesale book did exist with IDFC Bank. The fact is that as we progress the story forward over the next few years, we believe that we can build back the retail business from, say, about 30,000 crores on a combined basis of the two institutions, all the way back to about 1 lakh crore over the next 5 years. So this is not a projection, this is not a promise or anything like that, but this is basically a question to address to shareholders as to what is the management thinking. So from that point of view, I'd put that number out. The number two that's coming in my mind is that retail is a proportion of the book, which will probably come down to 30% from 90%, would actually go back to about 65 to 70% over the next 5 years again. So this is what we're thinking. So this is not something that should bother shareholders at all. The number two is that to the extent that the wholesale book exists there in IDFC Bank, I think the management has done a very credible job of cleaning up the books, and whatever residual is there, it just appears that they'll clean it up this quarter.
Mr. Vaidyanathan, good morning. What about competition? I mean, this space has been growing very fast, but growing with some big players that are well entrenched in the market. How do you plan to sort of penetrate the market?
First of all, we are in the lower ticket size of the market. We are not giving 1,000, 2,000 crore loans, which the large corporates have given. Now, as far as the lower ticket size of the market is concerned, we have close to about, say, 6 million customers on our side alone. In fact, 7 million customers as we speak. Now, that's a big diversification. Now, we think that this space is so large that even if more banks enter the space, the SBIs and the large public sector banks, even the private sector banks, this is just so large. And I think, therefore, we should not really worry about who's taking what market share. This is a story of underpenetration. This is a story of financialization. This is a story of democratization of credit. And that's a very, very big story.
Yeah, Mr. Vaidyanathan, good morning. In fact, that was my next question because, invariably you're always compared to Bajaj Finance. And you've seen the kind of stunning growth that Bajaj Finance has shown. And it's a business. I mean, of course, now, we go to Chroma and we go to other places. I can see that, that's Capital First along with Bajaj Finance. But in terms of catching up or in terms of garnering some more market share, your thoughts on that?
That is again a very big market in India. Now, it's not just Bajaj Finance, it's not just Capital First. Of late, we're seeing a large number of people entering into the consumer financing market. But that story is expanding not because of the fact that that market is growing. It's also because the amount of ecosystem has dramatically changed in India. You can go to a marketplace, you can meet a customer, you can get access to Aadhaar, you can get access to credit bureau, you can get access to a number of databases, you can do deduplication. You can do that instantly. So therefore, with the ecosystem evolving, I don't see any reason why that market, whether for Capital First, for other players, should not grow by anywhere about, let's say, 20% year on year.
Okay. Well, let me come to, once again, the shareholders' thinking, especially IDFC Bank, especially Capital First shareholders. You have bought IDFC Bank banking license. It will give you liabilities at 4%. As Capital First, you are probably borrowing at 7-8%. That would be the natural reason why anybody would want the bank license. But what is IDFC Bank's current account and savings account deposits? It's about 6-7%. So you've not got what you want, liabilities.
First of all, nobody's bought anybody. It's a merger of two institutions.
Okay, sorry. Yeah.
And secondly, this is a very important question, because if we say that we've got to grow the retail loan book to 1 lakh crores over the next 5 or 6 years, where is the liabilities going to come from? Now, this is, again, just like we talked to the assets market, liability is a very big market. Let me give you the numbers. The current account market in India is close to 10 lakh crores. The savings account market in India is about 37 lakh crores. Yes. So together is 47 lakh crores and growing at about 5% per year. That's a CASA market of India. Now, on 47 lakh crores, can we not get 40,000 crores over the next 5 years? That's all we need to build a good CASA.
None of the other PSU banks got it. It is still with SBI. It is still with HDFC. You know, they've all been in the race for so long. DCB asked Murali Natarajan, he'll tell you, liabilities have not come that easily. No. Do you, as you said, 7 million asset customers. Is it possible for you to translate them into liability customers?
Many of them will, but that's not the only story. And in fact, that cannot be the only story. Digital cannot be the only story. We need branches. So we will intend to put out, say, 500 to 600 branches for sure. And in fact, as the game plays out, even 1,000 branches. So when you put out between 600 to 1,000 branches and you provide payment solutions, it is inconceivable that you will not get CASA, because CASA comes from payments. CASA comes from the ability to allow people to transact seamlessly. On that front, I must say, while IDFC Bank may not have got the numbers on CASA, they have developed an exceptional architecture on how this can be enabled. So basically, they've done all the plumbing work. We just have to scale it up.
But you're talking about 1,000 branches, incrementally, right? 1,000 branches that you're going to add?
Cumulatively. We're talking of 600 to 1,000, actually. It's, you know, let me say first phase right now we're thinking of 600. That's what we planned the P&L for. But I'm not ruling out taking the game up. Now, you might well argue saying that why branches?
Yeah, because, I mean, you know, branchless banking, mobile banking has picked up so much. So,
well, if you go to a large bank in India, let me say 1,000 branches are table stakes. Now, of course, digital is a big story. We talked about how the ecosystem is changing with terms of, you know, Aadhaar-enabled payment services and mobile and Jan Dhan and all that. That is definitely changing. The ecosystem is changing. But that can't be the only game. So it's basically both the physical branch network of, let me say, 600 to 1,000 branches and a digital architecture. We believe together it's necessary. It's just not, it's not the digital alone.
The last results of IDFC Bank were not flattering. They did well more because of a one-time gain, some 81 crore. So will there be cost cuts? If you're not going to concentrate on wholesale, will there be, you know, while there will be hiring of one kind, will there be firing of another kind?
Actually, the way we should look at this is not about a quarter's result, about what the core profit of IDFC Bank is or what Capital First is. First of all, Capital First itself is carrying close to a quarterly run rate of 100 crores a year of core profits into the institution. As far as IDFC Bank is concerned, there we have to see when we put them together, what is the going opportunity? And that opportunity is not coming from this 80-100 crore that they posted last quarter. It is coming from the fact that our liabilities will get repriced. We are borrowing anywhere between 8.5 to 9% incrementally. Cost of funds of a bank is much lesser, let me say about 7.3% as per their own records of the last quarter. Now, that's a significant saving. Number two, the lending yield of the combined institution today can go up by close to about 200 basis points over the next 5 years, because the fact that Capital First yield is close to about 16 to 17%. So that brings a game. So when you increase the yield, you reduce the cost, the margin will go up. So we should not worry about what this quarter's profit are. We should worry about what the profits will be, say, 4 quarters from now, 16 quarters from now, and say 20 quarters from now. And that story will look really very, very good.
Will there be a lot of cost cutting that you're going to implement?
See, for us to improve the cost, that is a core profit, yes, cost is going to be an important factor. But what kind of costs? Is it people? That's not what we're thinking. Let me just say that most employees at the operating level management should feel absolutely comfortable because we believe that's not the storyline here. The story is not cost cuts. The story is synergies. The story is leveraging. Leveraging on their balance sheet, leveraging on their branch network, and for them to leverage on our kind of unique model that we built over the years.
Okay, actually, let me come to ROE. That ultimately, that's what your investors will want. Your ROE, that is Capital First, was 16%. Now, after the merger, I don't know what it comes down to, I guess low single digits. What can you promise by way of ROE and by when?
Let me tell you what we estimate the profits for the first year as a takeoff year to be. And I caveat this by saying that these are estimates and these are management estimates and these are not really guidances. But let me just say that our estimates for the first year are about 600 crores of profit. I believe that's a pretty good number to start a game with. Return on equity will come down from say 16% to probably say 4%. But I'm pretty confident as the branches roll out and as the merger strategy plays out, this 4 can continuously grow to 6, 8, 10, 12, 14, 16. We believe such a story is playable over the years. And I believe at some stage, you started the story by talking about investors' concern. We've seen the story play out at Capital First before. When our return on equity moved from, say, 0% to 8% on a stable basis, the market re-rated us from 1-time book to 3-times book. I believe at some stage, market will recognize the story.
All right, Mr. Vedanta, thanks a lot for joining us.
We wish you all the very best
exactly.
for that kind of a re-rating and that kind of a scaling up. And this is an action replay for you.
And I must say, just for the benefit of people who are watching, and particularly employees, that this can be done. And this is not, my belief is that this is not a conjecture. There is a solid business model behind it, and I believe it can be done. You can watch the story over the years.
Okay, Mr. Vedanta, thanks a lot. All the best for that.
Thank you.
That's Capital First. Before we take a break, just discuss that the market really is breaking out. The big contributor is IT. All IT stocks really are at the highest point of the day, led by Infosys. In fact, from the time we spotted, it's moved up even further. But even the Bank Nifty has moved up quite a bit. Ashwani is back with us. Ashwani, I think your first trade played out beautifully, but you reckon this is turning out to be a trending day because assumption was that market would fall today, and it's just first hour has proved that wrong.
Well, I don't use it often, but picture abhi baki hai mere dost. You know, this sort of movement happens when some large commercials, mutual funds, etc. have changed their view and big money has come in just to buy the early morning gap down. I mean, Bank Nifty was 150 points lower. It's now plus 50. The morning first take, Bank Nifty futures was at a premium of 150 points. Nifty was a premium of 60 points. If somebody is willing to pay those sort of premiums to get into the market, then obviously it's a long and positive day ahead. You need to get out of your short positions, rupee or crude, or forget about that. And that's the point I made in the morning also, that market is not willing to listen to all of that. Get into Nifty, Bank Nifty. And my sense is that you're already at fresh highs on Nifty futures. I think Bank Nifty could also surprise you because all the negative news people hoped for has come and we are not able to fall. That shows you the strength of the market. Imagine if tomorrow crude falls $2, what this market is likely to do. So, you know, the first indication is very clearly strong and all sorts of dips should be bought from here. Obviously, you know, rupee sensitives are doing well, but the entire market is doing well. So I think this is a change of call by large players on the entire market. Having said that, Ajanta Pharma is a buy with a stop of 1280, target of 1330. Oro Pharma is a buy with a stop of 698, target of 725. And Axis Bank is a buy with a stop of 645, target of 670.
Okay. Thank you very much, Ashwini, and congratulations. Clearly, it is turning out to be a day when the dips have been bought aggressively. We have to take a break on that note. We are coming back with someone who understands markets very well and has given great returns to his investors. Sunil Singhania of Abacus Asset Manager NLP joins in for a chat. Okay, straight ahead for now, before we get into that break, let's also leave you with some thoughts that we've got from that interesting conversation that the legendary Warren Buffett had with CNBC's Becky.
In terms of the battle of the retailers versus the brands and the willingness of people to change their habits, probably has a higher propensity for that than 20 or 30 years ago. So branded goods, branded packaged goods are a very, very, very good business in terms of return on tangible assets, but they're not a sensational business in terms of where you could be 5 or 10 years from now.